Knowledge is knowing that the ubiquitous tomato is actually a fruit and not a vegetable. Wisdom is knowing not to put that tomato into your fruit salad. Two wise men on my show today were both profiled in my earlier series, The Wizards of Dalal Street, A Fresh Breeze. Today, they graciously return to take stock of what has been a tumultuous year for equities. Please welcome Kuntal Shah of Oakland Capital Management and Sumeet Nagar of Malabar Investments. Gentlemen, welcome to my show.
Thank you.
Sumeet, let me start with you. You had a very colorful saying that when investors panic, they throw the baby out with the bathwater. Are they throwing out the baby in October, according to you?
Yeah, so I don't think we've still seen that yet. I think you did see that after almost 2 years since Demon, it was the first time when good quality companies at least started to correct or get to reasonable valuations. But the correction was still very short and it wasn't deep enough. So we haven't seen, sort of throwaway prices, sort of throwing the baby along with the bathwater. But yes, the valuations have become more reasonable, so you can at least invest in some quality companies now, which were out of reach for the last couple of years.
Okay, they're reasonable, but Kuntal, let me get you in. They didn't throw the baby out with the bathwater, agreed. But last week you threw the kitchen sink at the market. I mean, you had the RBI governor resign, you had markets fall, Dow fall, many bad news happening, and yet the market shows surprising resilience.
I think so. The market's narrative has changed dramatically, and I think so. What market is pricing in today is more accommodative policies at the central bank level, and I think so. Market has been already oversold in mid caps. If you see the discount of mid caps and small caps to the index, which earlier used to be premium in the last 2 years, have gone into a discount, and I think so there's a sense of optimism creeping in. So it's buy on the dips kind of a phenomena.
Buy on the dips.
Yeah.
But you said accommodative policy, but I mean, the Fed has raised rates in America. People have moved money from emerging markets to developed markets. So what's accommodative here?
So I think so the currency has stabilized, and if you see the inflation differential between US and India today is now upwards of 4.5%. So there is a scope of slight accommodative policy at RBI level. And I think so running into election, I think so we will see some amount of populist policies kicking in.
Are you telegraphing a suggestion to the new governor we have?
I'm sure he's listening.
Okay, let me get to you. Kuntal talked about brutalization of small caps and mid caps, and that's your sweet spot, right? Have you changed your thought process that maybe small cap, mid caps aren't the place to be?
No, not really. I think you know that when you invest in small cap, there is going to be a volatile journey. It's not going to be a straight line. But you know that smaller companies have more room to grow over longer periods, and they've shown that. And generally over longer terms, as a result, then end up outperforming the large cap index. And so the same thing would happen. So I think from our perspective, you take advantage of that sort of little bit better valuation environment that you have today, and you keep investing in great companies that you think will go on to become 5 times or 10 times over the next 5 or 10 years.
But in terms of the economy, I mean, you had 2 major changes that took place in the last 5 years or so. We had GST come in, and we have digitization. GST means that the big gets bigger, basically, because the organized sector gains. And digitization means there's no barriers to entry. So despite that, you feel the small caps will keep outperforming the larger caps?
Yes, I think that's just the smaller companies outperforming larger ones. That just happens across geographies. I think you've seen that. But it takes time for it to happen, right? So just like a smaller kid will stumble along the way more than a larger kid, the smaller companies also have their ups and downs, but over long periods they always outperform. And I think the good companies, and particularly I think that's the focus. If you're not looking at investing in sort of several thousand, smaller.
Not the average small cap.
You're looking at a subset. And the differentiated small caps, the one which have good moats around them, you'll find that they will figure out a way to differentiate themselves to stay ahead of the competition. And so that's what we see that even today.
That's a recurring theme in your portfolio selection, widening the moat.
Mm-hmm.
How do you judge the moat of a business? Can you give me an example?
Sure. So, one of the example in our portfolio, let's say a company like Safari, right? So it's a great
luggage manufacturer.
It's a great industry, a lot of tailwinds behind that. But let's say when Sudhir took over the company 6 years ago, it probably didn't have much of a moat. The only moat, if any, was that the brand recognition was there. Everybody knows what Safari stands for.
Yes.
But it didn't have much more. Over the last 6 years, he has built the right team. They've improved their product profile. They've increased distribution. With GST coming in, the other unorganized guys who were importing and selling without paying taxes, they've come under pressure. So they, in this period of time, they've actually strengthened and widened the moat that existed around their business. So that's just one example, but we find many companies who take advantage of crisis to strengthen themselves and come out stronger.
Kuntal, what started you off on a journey was not moats, but you feel your middle class background. It made you a better investor. What about being middle class helped you become a better investor?
See, when one comes from a humble background, one is very cognizant of the fact that the capital you have is very irreplaceable and very sacrosanct. And
lose it is gone.
And yeah, one large loss can write off years of compounding. So successful investing, Ramesh, is striking a right balance between having confidence and conviction of being right and betting against the market, and at the same time having humility enough that you could be wrong or that things could change adversely against you, and that you are dealing with a lot of smart people trying to compete with you. So striking the right balance, I think so, is at the heart. And if you see, the compounding is the essence of investing, and difficulty in getting it is well known. And compounding is highly, though non-linear, is highly asymmetric in the sense that downsides are more painful and more difficult to catch up to. And that's why compounding of stupidities is highly painful.
Okay, but that middle class background taught you that, preservation of capital. But I read in an interview, Kuntal, you said that if you could choose between longevity of a business versus slightly poorer returns, you would seek longevity. Why is that?
Ramesh, it's very simple. The formula of compounding, which is quote attributable to Einstein, though I don't know whether he said it.
Eighth wonder of the world.
It is the eighth wonder of the world, and the formula states that the future value of any business or asset is the present value times 1 plus rate of growth raised to n. Now, rate of growth is what most of the investors focus on, and the direction of that. But if you see, the longevity of growth is exponential function, and actually mathematically it dominates the wealth creation. So if you could get a company which is more predictable and consistent, you would have much more larger compounding, both from the compounding of the cash flows, as well as the. I've seen that investors have huge propensity to overpay for consistency of cash flow.
But Warren Buffett, this might be hard to believe, that before he was 50, he earned 99% of his wealth after he was 50, right? You know that, Sad?
Yeah.
So that's the magic of compounding, right? I mean, that 1 billion became so much more, 50 billion, 60 billion now, through compounding in the next 25 years.
People come and ask me, are you a value investor, growth investor? Some of them invented a new term in between also called, are you a growth and reasonable price investor? It all doesn't make sense. Ultimately, a successful investor is a capital allocator with the job of compounding capital to avoid taxes, inflation, and bad decision making. If you can do this, you'll be fine.
What kind of investor are you, Sumeet?
So, I mean, the way we see it, that investing, there's only one type of investor. And as Kuntal said, you're not value versus growth. I think growth is a component of value.
Of value, yes,
right?
Of course.
So you always, I mean, as an investor or as any purchaser, you always want to find value and you want to pay less for what it is worth. And so that's what we're looking for. And then you want to make sure that the value that you find today, it can actually compound and grow over a period of time, and price sort of catches up with that and keeps growing along with that. So that's what we're looking for.
But in order to find the value, you're very fond of using a checklist, right? What is in your checklist, and what are the top 3 things you will check for?
So at a very high level, it's simple stuff, right? It's what is a very high quality business, an outstanding management team, a reasonable valuation. Right? But these are very generic things. So you need to drill down deeper into that, right? So what makes up for a great management team, for example, right? So then you sort of divide that into 10 things that go underneath that. So you're looking for people who have operational capability, who are good capital allocators, where you find that it's not just one person, there's scalability within the team. The next level team is smart, capable, is well motivated, compensated. There's integrity, there's passion. So there are many of these components that go within that, and you want to make sure that you're ticking most of those, as you go and evaluate the
So
company.
you actually have a checklist made out of 50 points, 100 points, and as you evaluate a company, you tick them.
Yeah, you want to make
positive,
sure
negative.
they're there. And also, I think see, the key difference between a checklist and check the box is that you're not just saying that, okay, I just see and tick the box. I want to also understand that for a specific business, that certain part of checklist is what is most important, and that's where you put the emphasis. And so let's say if a company that makes products and that differentiates itself because of its manufacturing, you want to make sure that you understand that. You've got to go to the plant, you want to see how they make it. How is it that they differentiate themselves? Do the competition have that or not? So you want to establish that, right? But let's say if it's some consumer product companies where making the product has not really much differentiation. It's all about the
Marketing,
branding, differentiation or distribution, right? And so in that case, that part is not as important. So you need to figure out for which type of companies where
What
to
checklist
emphasize.
applies where?
Yeah.
How about you, Kuntal? I mean, would you favor a checklist type of approach?
Intuitively, I'm a very concentrated investor, so obviously I can't afford to take the eyes off the handle, and obviously you have to drill down equally, that as Sumeet has said. But to best of my knowledge, I haven't come across a single checklist which fulfills all the circumstances. So you keep refining as you learn, and learnings are always there at each stage of the investing career.
You know what they say about the television business, that our product is commercial. So we'll take a break, come back and chat some more with Kuntal and Sumeet on the Wizards of Dalal Street, a fresh breeze. Welcome back to the Wizards of Dalal Street, a fresh breeze, where I'm chatting with Kuntal Shah of Oakland Capital Management and Sumeet Nagar of Malabar Investments. Sumeet, let me come back to you. We talked about small cap investing that you're famous for. But small cap investing is not a theme-based business. You've got to knock the doors or bottom-up stock picking. Give us a flavor of where you're finding values in the current environment.
So, in general, you find value where there may be some concern, right? Where there may be a little bit of a pressure in the market today. So, for example, over the last year or so, one of the areas that was initially beaten down was, let's say, IT, right? Because it was an area that wasn't very exciting. Rupee was stable or appreciating for many years. There was a lot of changes that are happening in technology. And so as a result, all the companies in that sector were beaten down. But there's always a differentiation, right? So while most of those IT companies are truly sort of me too, and they're doing very similar things, you always find somebody who's differentiated. So one example was NewGen. So the software company, they actually make products. So as opposed to services company, they're actually product-oriented, had fantastic products, had very strong market share in the private banks business in India. Slowly they started to grow in the US. That business started to get traction. And all of that was sort of lost in how the sector was treated. And so for a period of time, as the business was accruing value, its price was not going anywhere. And so it gave us a chance to accumulate that and build that. So it's just an example of,
Example of baby out of the bathwater in the technology space?
Yeah. And then eventually, I think if the businesses keep compounding the value, price eventually catches up with that.
Correct. Any other sector? I mean, this is 2018, mid-caps have fallen a lot. Give me some flavor of where you're finding value.
Yeah, so more recently, for example, without sort of picking a name, right, you just think about financial companies have been beaten down a lot, right? And for maybe in some cases for the right reasons. But let's say, home finance companies, right? I mean, these are companies that have a very, very long history ahead of them, right?
Long
history of future, right?
Long runway.
Had long runway of growth. And you've seen in other countries that mortgage to GDP ratio can be a lot higher compared to where India is today. So yes, in the short term, their margins may get compressed because interest rates may be rising. But over the very long term, they will still end up creating good opportunity and good business, but today they're beaten down. So that's an example where you can find some interesting ideas. And
Kuntal, let me come to you. I mean, you've had an eye for some great stocks. You picked something like Bajaj Finance in its infancy. How does the NBFC sector look? And then we'll get to where you're finding value.
I think so. This is a period where I think so boys will be separated from men. And you will see that ability to lend of many of these companies will be severely constrained. And I'll give you a simple example. If you are running a levered business, then equity is supposed to cushion losses in the business. But here you have levered business run by promoters who themselves are levered. And I think so that's a heady cocktail. So you will see many of the competitions going down. And I think so a slight rising interest rate environment will make it very difficult for any Me Too NBFCs to lend. I think so a year back it was fashionable for every business house to consider launching an NBFC, poach some people and do it. If you are distributing money, there's a long queue to come, but the problem is in recovery.
Always.
And I think so this is the second oldest business in the world, Rameshji. And I think so the execution and the technology are the two big differentiators in this space. And I think so you'll see a tremendous market share swings away from some of the incumbents who may not even come back.
So the sector looks good, but you have to pick your spots within the sector.
Yep.
That's what you'd say?
I would tend to agree.
Where else do you find value? You have an eye for finding multi-baggers. So tell me, where are you spotting value?
So two recurring theme I'm looking at is again the same thing, supply-led disruptions. So if you look at two sectors, real estate, there's been huge supply disruption. RERA is coming. This is a class of asset which was the highest. 57% of India's wealth in real estate, and you had no regulator. And
no market cap.
And no market cap. It was less than 1%. Ultratech market cap is bigger than the entire realty index today.
Combined.
Combined today. And in Vietnam, there's a company called Vini Group, which is 1/12 the India's GDP. It's larger than ELF today. So you have a lot of this inconsistencies, and I think so a lot of supply of realtors is going to disappear. Same thing is happening in specialty chemicals due to the disruption in China, what we are seeing. So I think so it's very difficult to grow demand exponentially or in short period of time, but supply can disappear overnight. So supply-led disruptions can lead to market share consolidation. Another area where I find you can't have an economy of 2 trillion growing at 6-7% with industrial and capital goods sectors having a profit pool of less than $500 million. So while the populist policies would favor consumption initially, but at some point of time capex will become irreplaceable, and you have some like a company like BHEL is available below the net receivables. So not to say that I'm recommending buying that, but I'm saying you are finding disconnects in several such sectors where there are disruptions primarily due to supply, and that is primarily originating from regulations like GST and RERA and so on and so forth.
Great point, but you talked about PSUs in BHEL. The entire sector is beaten down. No one wants to look at those PSU stocks. Does the contrarian in you say there's value there?
Rameshji, if you look holistically, the government of India is borrowing from small savings scheme at 8.5% post-tax. Pre-tax, that's a borrowing cost of 11 to 12%. And the government is putting this money in PSU and earning a return on capital employed far lesser than the borrowing cost. So in long run, this is a path to bankruptcies. So you need a statesman like Margaret Thatcher who would come and, like in 1970s, Margaret Thatcher in 2 years privatized everything with what British attached to it, and you
all the Russians
30,
did it too.
and 30 years of boom ensured, and this is the only way you can bridge the twin deficit of both fiscal deficit and current account deficit.
So rather than demonetization, the government should have done privatization?
I would like to think so. That would have a multi-decade opportunity to lower the cost of capital, because once the government is out of the business, the government as the sole business would be to provide right regulation and framework and laws. Right now, today, you have government as a competitor in all the sectors, which is not a healthy capitalist society.
I think it's a safe bet that that's not going to happen anytime soon, though, whatever you say. But that's your learning and that's your lesson. But I want to talk about you, Sumeet, to you about 2018. It's been a tumultuous year for equities. So many things have happened. What did you learn in 2018? It's a learning experience every year.
Yeah. And I think it's a good exercise to each year to sort of, look back, take stock. But it's also important to make sure that you're not just learning from a short period, because you may end up getting distorted learning. So you need to look back over a little bit longer periods. And I would say that one of the things that we found was that throughout the last 3 or 4 years, we found that the valuation levels were somewhat elevated, right? And as a result, we had a little bit of a defensive stance. So we kept some level of cash, take advantage of any declines. We had maybe a couple of declines in 2016, so we did take advantage of that. But I think as 2017, you saw a big run-up happen, perhaps we should have been even more conservative at that point in time. We were conservative, but same way as we had been in the prior 3 years. It's always, the calibration is always very important. You can be right, and yet, if you don't act enough, it doesn't sort of get you the same result.
But you're dealing with a lot of uncertainty. 2019, we have national elections coming up, trade war simmering on the distance, the Dow looking tired. How does Sumeet place his bets, or how does the stance in equity markets in India over 2019?
See, I think from a long-term perspective, we always maintain that India is a great place to be. But, the road is going to be rocky, especially at the juncture where we are. At this point in cycle, you know that over the course of next 2 or 3 years, at some point, global markets may come down. And it will have its impact on India. But as long as the economy keeps on going well, and if you invest in good companies, I think you're going to be fine. So I think we're investing just a little bit more cautious, making sure that the future, which can have different scenarios, in each of those scenarios you end up doing at least okay, right? And under no scenarios you should be in a situation where you end up losing a lot of money. I think what Kuntal was saying earlier, right? You want to preserve that capital.
As Buffett says, preserve your capital. Rule 2, remember rule 1. But irrespective of what happens in the national election, this could turn up a khichdi, as people say. You would remain bullish?
Well, it's also a function of what happens in the market. But if you don't have, let's say, a decisive mandate and you have a khichdi, as you say, maybe the markets react negatively at that point in time, and that may throw up certain opportunities, right? I think for many of us, I think we're going to be buyers in Indian equities over the next 2, 3 decades.
Right.
Any time in the market's correct is a good time to add.
That's a thumping confidence I've ever heard. 2, 3 decades, you have long-term buyers in India, long-term bullish in India. Great learnings. Kuntal, let me ask you the same question. What have you learned in 2018?
Well, my key learning in 2018 is that in bear market, the securities and stock revert back to their original owners because they had lent out to them in bull market for a fee. And
the guys with experience take it back.
In stock market, people with money meet people with experience get money, and people with money get an experience. Having said that, I've realized that after 2008 especially, that your opportunity set is not the current opportunity set. You have to be aware that what could be the probabilities 3-4 quarters down the line. Let me give you a little detailed explanation. If I'm investing my capital in a company's management, I don't expect that management to just keep investing capital just because funds are available to 100% of the time, or do an overpriced acquisition, or invest in projects which have low prospective returns. But now when I look at the capital market, there are host of investors who have inability to hold cash. They have mandate to be 100% invested, and it's fine to take a stance that volatility is part of the game and in long run stock will outperform. But the key is long term is a series of short term, and your capital structure in terms of longevity, the duration of capital, your investor base,
and buying at the right price,
and your temperament and cash and courage to buy the right time needs to be there. If all these constructs are not there, then the part dependency kicks in, and you need to be conscious of that. And a lot of them are again closet indexer, in the sense that they have they've collected a zoo of all varieties of animals, and it's further compounded by distributors who give them multiple products, which effectively means almost all the retail investors which I come across are effectively owning the index, and the better way to would have been to do through
just
an
buy
ETF.
the index itself. Kuntal, I've been to your house, and you have one of probably the finest collection of books. Tell me something you enjoyed in 2018.
Well, I think so. Since we are on topic of compounding, instead of giving one, I'll give you two.
Okay.
And I think so. The book which I read and enjoying reading in 2018 was the Mastering the Market Cycle by Howard Marks, where
yes.
he speaks about the same mean reversion of market valuations, profit margins, and so on and so forth. And another book which I really liked reading was Bad Blood. It's a story of Theranos.
A brilliant story.
I think that every investor should learn it. I think read this book. It was a one-seat reading for me.
Great. Thank you for your two picks. Sumit, last word with you. Which is a book you enjoyed?
So I'm always a little bit behind on my reading. So I think the book that I read and enjoyed the most in this year was actually slightly older. It was also by Howard Marks. It's the most important thing.
Yeah.
Right? So it was on my reading list. So this year I picked it up and read through it, and I think it's brilliant, right? And so I think there is an inherent complexity to investing business, that you need to think about the quantitative, the qualitative. You need to weigh them correctly. You need to get many different things, right?
It's a full-time job.
And so I think there's this tendency always to simplify, and I think it's a good reminder that as an investor you need to think about many different things.
Second level outcomes, third level outcomes.
Yeah,
correct.
absolutely.
Great. Sumit, Kuntal, thank you so much. They say the pen is mightier than the sword, and the brain is wider than the sky. Thank you so much for sharing your wisdom with me.
Thank you.
We'll see you on another episode of the Wizards of Dalal Street, A Fresh Breeze.